If you are planning to melt down your RRSP this year to dodge a big tax bill at 71, there is a 15% hidden tax most retirement calculators never show you. You've probably heard the advice already. Pull money from your RRSP now while your income is lower, shift it into a TFSA or a regular account, and save yourself real money in tax later. On paper, it looks airtight. Here is the part that gets left out. For a lot of Canadians, taking $30,000 out of an RRSP does not just cost you your marginal tax rate. It can trigger the OAS Recovery Tax, and that can claw back up to $10,000 of your old age security every single year. Maybe you've already run the numbers yourself, or an advisor has walked you through a version of this plan. It can feel like the responsible move. Get ahead of the tax man before he gets ahead of you. But the OAS Recovery Tax works quietly in the background, and by the time most people notice it on their notice of assessment, the withdrawal is already done and the room is gone. Today we're breaking down what I call the OAS trap, along with something called sequence of returns risk. Together, they can turn a smart-looking tax move into a $50,000 mistake if the timing goes wrong. I'll show you the exact 2026 income thresholds where the meltdown math breaks down, and how to pressure test your own plan against a market crash before you touch a single dollar of that RRSP. If you're between 55 and 65 and you'd like to keep more of your OAS out of the CRA's hands, hit subscribe. This channel is built around the math the big banks leave out of their brochures. In 2026, the OAS Recovery Tax kicks in the moment your net world income crosses $95,323. Past that line, the government takes back 15 cents of your old age security for every extra dollar you earn. It doesn't matter whether that dollar came from a pension, an RRSP withdrawal, or investment income. Once you're over the threshold, the clock starts. Net world income sounds like technical language, but it just means everything you're taxed on in a year added together. Your CPP, your pension, any RRSP withdrawal, any investment income sitting outside a TFSA, the CRA adds it all up on one line of your return, and that line is what decides whether the clawback kicks in. Here's the part that catches people off guard. If you're already sitting in a 30% tax bracket, and you trigger that 15% clawback on top, your real tax rate on that RRSP withdrawal isn't 30%. It's 45%. That's the effective marginal tax rate, and most online calculators never show it to you because they're built around your tax bracket alone, not your benefits. Nobody plans their retirement around a 45% tax rate. Most people think they're being smart by staying under the 30% bracket, and they never realize the clawback quietly doubles the real cost of that decision. I've watched this happen to people who did everything right on paper. They ran their numbers through a basic tax calculator, saw a reasonable bracket, and pulled the trigger on a large RRSP withdrawal without ever checking what it would do to their OAS. Protecting your retirement means remembering you're not just a taxpayer. You're also a benefit recipient, and the CRA treats those as two separate pockets to reach into. Most meltdown strategies you'll find online only look at your federal and provincial tax brackets. They miss the fact that a single $30,000 withdrawal can push a fairly ordinary retiree from a safe $70,000 income straight into the clawback zone above $95,323. Here's what that looks like with real numbers. Say your base income from CPP and a workplace pension is $75,000 a year. You decide to melt down $30,000 from your RRSP on top of that. Your total income for the year is now $105,000. Subtract the $95,323 threshold, and every dollar above that gets clipped by 15 cents. That works out to $1,451.55 of OAS gone every single year that income stays that high. That's real money, gone every year, just from one withdrawal decision made without checking this one number first. That's the tax hit, but it's only half the story. What happens if you move that $30,000 into a regular investment account and the market drops 20% the very next week? Let's talk about a risk most meltdown strategies never mention, because it has nothing to do with taxes and everything to do with timing. Financial planners call it sequence of returns risk, and it matters more the closer you are to actually living off this money. I call the version I use the meltdown stress test, and it's built on one assumption that sounds reasonable until you actually test it. The assumption is that growth in a regular, non-registered account will outpace the tax you pay to get the money there in the first place. Here's why the timing matters so much more once you're near or in retirement. When you're 35 and investing, a bad year is just a bad year. You have decades to let the next good year even things out. When you're 62 and you've just paid tax to move $100,000 out of a sheltered account, you don't have 30 years to wait for the recovery. You may need that exact money for daily living within the next 5 to 10 years. Here's where that assumption breaks. Say you move $100,000 out of your RRSP into a regular investment account. To do that, you pay $30,000 in tax up front. That leaves you with $70,000 working for you outside the RRSP. Now imagine the market drops 30% in year one, which has happened more than once in the last 20 years. Your $70,000 is now worth $49,000. Inside the RRSP, that same $100,000 would have dropped to $70,000 too, but none of that loss would be locked in by a tax bill you already paid. The RRSP just sits there, sheltered, waiting for the market to recover on its own schedule, not yours. I used to tell people that melting down was close to a math certainty, as long as your bracket made sense. Then I watched someone I was working with make a large withdrawal in 2022, right before the tech wreck hit. They paid their tax at the top of the market and sold their investments near the bottom. It took 4 years just to climb back to break even, money that would have stayed fully sheltered if it had never left the RRSP. Let's put the two paths side by side. Scenario A, you leave $100,000 sitting in your RRSP. The market drops 30%. Your account is worth $70,000, but the tax on it is still deferred, so that number isn't final yet. Scenario B, you melt down that same $100,000. You pay $30,000 in tax to get it out, invest the remaining $70,000, and the same 30% crash hits. Now you're sitting at $49,000. That's $21,000 less working capital to recover with, and the crash hit both paths at the exact same time. So if the math carries this much risk, why does almost every retirement channel still push melting down as the smart move? Because most of that advice is written for someone with a 7-figure portfolio and years of runway to absorb a bad year. That's not the reality most people watching this are living in. It's not a bad plan on its face. It's just a plan that assumes the market will cooperate with your timeline, and markets have never once done that reliably. A lot of the meltdown advice you'll find online is written with a very specific person in mind. Someone sitting on $1,300,000 or more in registered accounts with no real need for the money for another decade. If that's not your situation, it's easy to watch those videos and feel like none of it actually applies to you. Have you ever watched one of these meltdown videos and thought, this makes sense for someone else, not for me? That reaction is common, and it usually means the math being shown was never built around an account your size to begin with. Meet Gary. He's 62, and he has $250,000 in his RRSP, not $1,300,000. Standard advice would tell Gary to start melting down aggressively right now, while he's still in a lower bracket. But Gary also needs some of that money for a new roof and a few years of travel starting in about 5 years. He can't afford to lock it into an aggressive tax move today and hope the timing works out. He's not chasing an early retirement fantasy. He just wants the roof fixed and a couple of trips booked without wondering if he's making a tax mistake that costs him later. There are really two paths here. Call the first one the fragility path, an aggressive meltdown that triggers a big tax bill now and leaves less cash on hand if something unexpected comes up. Call the second the resilience path, smaller, more strategic withdrawals that lean on tools like the basic personal amount, which sits at $16,452 for 2026. The basic personal amount works like a standing exemption. Every year, you can earn income up to that amount before federal tax applies at all. And for someone drawing down an RRSP slowly in retirement, that room adds up year after year. Every dollar Gary withdraws up to that amount in retirement, with no other income in that particular bracket, can come out close to tax-free. If Gary melts down hard right now, he gives up the tax-sheltered compounding his RRSP would have kept working for him. If he waits and draws it down carefully once he's actually retired, using the basic personal amount and his lower brackets year by year, his average tax rate over time can land close to zero. Same account, same eventual withdrawal, very different outcome, just because of pacing. Gary's biggest threat isn't the tax bill waiting for him at 71. It's something quieter, a kind of fear around ever paying tax on this money at all, even when paying a little now would save him a lot later. There's a well-documented behavior in psychology called loss aversion. In plain terms, losing a dollar feels worse than gaining a dollar feels good, even though they're the same size. Apply that to taxes, and you get people making decisions that actually hurt their own net worth, just to avoid handing money to the government. Picture two versions of the same $10,000. In one version, the CRA takes it as tax. In the other, your portfolio loses it in a bad month. Most people report feeling far worse about the first one, even though their bank balance ends up exactly the same either way. That gap in how it feels is loss aversion at work, and it's a completely normal part of being human, not a personal failing. It's normal to feel some anger here. You've worked for 30 or 40 years to build this money, and watching a chunk of it disappear into tax can feel personal, like there's a silent partner in your RRSP who never contributed a dollar of the risk, but still shows up expecting a cut. That reaction makes sense. It doesn't mean the reaction should drive the decision. This is where a lot of meltdown plans go wrong. People get so focused on the tax bill itself that they lose sight of what actually matters, which is how much spendable income and legacy they end up with. A meltdown that saves you $10,000 in tax today but costs $50,000 in lost long-term compounding isn't a win. It's a worse deal dressed up as a smart one. The number that should guide you isn't tax paid, it's net spendable income, what actually lands in your pocket and stays there after every cost is accounted for. None of this means the anger is wrong. It just means the anger makes a poor financial advisor. So how do you take the emotion out of it and make the decision on the actual numbers? There are 3 specific levers that work under the 2026 rules, and they're a lot simpler than most of the advice out there makes them sound. If you're weighing a meltdown this year, there are 3 filters worth running your numbers through before you touch anything. The first is what I call the $95,000 ceiling. As a general rule, don't withdraw RRSP funds that push your total income above the $95,323 OAS threshold unless you already know your future RRIF minimum withdrawals are going to force you into a 40% plus bracket anyway. In that case, some tax now might genuinely beat a bigger tax bill later. Your RRIF minimum withdrawal percentage climbs automatically as you age, so it's worth running that projection now rather than waiting until it forces your hand at 71. The second filter is simple. Fill your TFSA first. Use your full $7,000 room for 2026 before a single dollar goes into a regular, non-registered account. Growth inside a TFSA is never taxed, while growth outside it is, so the order you fund these accounts in actually matters. The third filter is asset relocation rather than a full meltdown. If you do need to shift some money out of your RRSP, consider moving your bonds and GICs into the RRSP and keeping your Canadian dividend paying investments in your non-registered account, where the dividend tax credit can reduce what you owe on that income. Here's a mini case worth sitting with. If you already have a workplace pension paying you $90,000 a year, a meltdown is almost always the wrong move because you're already close enough to the clawback zone that the 15% hit lands on nearly every dollar you pull out. It's not a personal failing if that's your situation. It's simply math that doesn't favor a withdrawal beyond what your RRIF will eventually require anyway. Before you make a final call either way, there's one more thing worth understanding, a lesson the market already taught a generation of retirees back in 2008. In 2008, the market crashed hard, and RRIF holders were still required to pull out their full minimum withdrawal that year, even while their account values were falling. It got bad enough that the government stepped in and temporarily reduced the minimum RRIF withdrawal rules because retirees were being forced to sell investments at the worst possible moment just to meet the rule. Anyone who was drawing down a RRIF through that stretch remembers it. Watching your statement shrink while the rules still made you pull money out and sell at the bottom is not an abstract risk. It happened to real retirees within living memory. Here's the part that gets missed in most meltdown conversations. Canadians are living longer than ever, with average life expectancy now past 82. A meltdown at 60 quietly assumes you won't need that tax-sheltered growth still working for you at 85 or 90. That's a big assumption to make 30 years in advance. If you empty the tank early just to save some tax now, you're giving up a kind of longevity insurance, the tax-sheltered growth inside an RRIF that keeps working for you well into your 90s, long after any tax savings from a meltdown would have been spent. So where does that leave you? A meltdown is a tool, not a rule everyone has to follow. If it pushes you into the OAS clawback zone or leaves you exposed if the market drops right after you move the money, it's fine to leave that tool in the drawer this year. Retirement was never really about beating the CRA at some kind of game. It's about having enough reliable cash flow to actually live the life you planned for without lying awake wondering if you gave away room you can't get back. I don't know the details of your exact tax return, and no one making a video on the internet does either. Take these numbers to your accountant or a CPA before you make any final decision on this. If this helped you spot a gap in your own plan, subscribe